In the mortgage market? Join us for another episode of FDM Brews to learn more about trends and updates in the mortgage industry that can help you get your clients pre-approved for the home of their dreams.
Hi, gentlemen. Welcome back. We've got a new look, don't we?
We do, Cindy. It's actually pretty snappy.
You have so much energy. All I could think about was coffee, coffee, coffee. This is a perfect way to wake up in the morning. You got the positive energy. You've got something interesting to talk about, and you're helping people succeed. So thanks so much for coming back, Brett and Nitesh. Good to see you.
Happy to be here, Cindy. And, that energy may come from about 27 cups of coffee I drink during the day. So that may help a little bit.
Definitely. Gotta keep wired, right?
Absolutely.
So we're closing down on the end of 2021, and everyone thought we would be completely past COVID by now. But, we're all on these varying stages of recovery. And you're telling me some interesting facts about, small business entrepreneurs and how the impacts are affecting them in growing and building their families and, taking advantage of what's happening in the real estate market. So I just thought, wow, this is a great topic. And how can we help prepare our real estate agents to work with these entrepreneurs, and how can we help them get into the home of their dreams sooner rather than later?
Cindy, it's interesting, right? Obviously, we thought when COVID started, it was 2 weeks to, slow the spread, right? That turned into 1 year. Now we're really coming into 2 years. And with the Omicron variant and some other issues, and, because it's a virus, you're starting to see shutdowns again in this winter. So it's something that's going to be with us a long time. But what we wanted to talk about is there are some long-term implications about COVID and how it impacts our business. And that's what we wanted to help people understand today. Unfortunately, like you said, different areas of the country are at different stages. But with the Omicron variant, some other things popping up, it's kind of evident that it's not going away. So we have to think about other solutions that not only help us address the problems that the first 2 years of COVID caused, but what's going to happen afterwards. So these solutions are designed to help the area of the market that was disproportionately negatively impacted by the impact of COVID-19 and government policies as a result of that.
Definitely. I know as an entrepreneur myself, you've got PPP loans that came in, the grant money that came in. And so, that P&L sheet's all over the place. So
it is, and there's some chat we'll touch on a little bit with the Paycheck Protection Program and things that you have to be careful of as an entrepreneur, especially when buying real estate. But most importantly, strategies to help you deal with the declining cash flow that you experienced in 2020 and 2021.
Sure. Did you have a presentation to share?
I do, Cindy. I'm ready to pull it up.
Right on. Let's get going.
That. I'm going to share my screen and hope my technology wizardess will work. Okay, there we go. All right. Well, Cindy, as we talked about, right, COVID-19 is something we're coming on 2 years of dealing with it, right? It first appeared to be an issue in the United States. Actually, when we think about it, because we all have COVID fatigue, was actually January of 2020. And, next month we're going to be January 2022. So as I shared with you, two weeks to start to slow the spread has turned in now 2 years and counting. And because of it, we were dealing with some challenges that nobody ever faced before. I mean, how do we deal with this, right? The last time we had this type of pandemic was the Spanish flu in the early 1900s, right? So this is something that's new, and how we reacted to it and how the government reacted to it. There's always unintended consequences, and that's kind of what we're dealing with now. So let's talk a little bit about what happened, and then what solutions do we have to help people get through this part, right? So when we think about it, and we're going to look at a segment of the market that was disproportionately negatively impacted. If we're completely honest, COVID-19 wreaked havoc on small businesses. Right now, a lot of it, and I'm not going to get political, but there were government policy decisions that shut down small businesses, that they couldn't open, whether it was a restaurant or a gym or just regular businesses were shut down well past 2 weeks, which turned into 6 months, which turned into a year, depending on the state that you were in. Businesses were shut down. It had nothing to do with them. That's why things like the Paycheck Protection Program or the Emergency Disaster Relief loans came into play to try to help these businesses stay intact. Now, Amazon, Target, Walmart, Costco, right? They all had record years in 2020 and 2021 because they were allowed to stay open. Now, there's always perplexed me a little bit because COVID had to be the smartest disease I've ever dealt with, because if I went into Target, it wouldn't impact me. But if I went into Jane's restaurant, it would, right? So the reality is Amazon, Target, Walmart, and Costco are those big box stores. They had a huge advantage. They stayed open. They stole our self-employed entrepreneurs' business, and we are now leaving with those challenges. The small business owner, the entrepreneur, they were forced to deal with shutdowns. That severely impacted business income. Now, I was listening to, I listened to the financial news most of the day. And one of the things that was interesting is, two very good capital markets folks out of Wall Street were saying, look, the reality is small business America was shut down for 2 years, right? And you're dealing with them now, right? Whether it's mask mandates or vaccine mandates. And like I said, I'm not trying to get political, what we believe or not believe in, but there is a reality of how it's impacting business, the supply chain crisis and inflation shutting down businesses, right? So our small business people, for example, dealing with the supply chain, Walmart can go fix it themselves. Actually, Walmart is actually contracting their own freighters from China and other places to get goods, where a small business owner can't do that, right? So that unfair advantage has negatively impacted our small business and entrepreneur more than the other folks, right? Now, what has that done? Well, there's a perceived risk for self-employed borrowers. That actually forced Fannie Mae and Freddie Mac to implement COVID-19 overlays for self-employed borrowers, right? So think about what's going on. Self-employed income dropped during COVID-19. That was terrible. Entrepreneurs were struggling. At the same time, Fannie Mae and Freddie Mac made it harder to qualify for a loan for a self-employed borrower. So that's like double jeopardy. Wait a minute. Policies outside of my own doing forced me to shut my business, had my income drop, yet because that happened at no fault of my own, Fannie and Freddie said, okay, well, that's risky, so we're going to make it harder for you to get a loan. So now you're getting hit from both ends, right? So that's kind of what we're faced with today, is the unique challenges that we're creating with. Now, the problem is 2 years into this, maybe 3, right? We have to be realistic. We have to be candid that we might be dealing with COVID through 22, right? So the longer we're in the COVID challenges, the longer it's going to take the smaller business to get out of it. So what's happened? Income severely impacted in 2020 and 21. What's happening now is when you apply for a loan and you're self-employed, if you're looking at Fannie Mae, Freddie Mac, we're looking for the last 2 years' tax returns. So wait a minute, my income dropped because of no fault of my own, but when I need to get a loan, I have to go give you my tax returns, and my taxable income is reduced, right? Most loan programs, including jumbos, require 2-year tax returns for qualification. Some programs, Fannie Mae, Freddie Mac at times, will let you for 1-year tax return, but it really doesn't matter because the taxable income for most small businesses or self-employed people have been reduced for the last 2 years. So 1-year, 2-year tax return really doesn't make a difference, right? If you got impacted negatively in 2020, you probably saw some of the challenges in 21. Add the self-employed COVID-19 overlays that Fannie and Freddie have put in place, and it's become extremely hard for a self-employed borrower to get a loan. Self-employed borrowers are going to be dealing with the impact of COVID-19 for years. Even if we come out of it, right, we get through this pandemic. And like I said, there are signs that are showing that we're going to come out of it. But the reality is the negative impact of this is going to be with small business entrepreneurs for 2 or 3 years. So what can we do to make that work? Letitia's got a few ideas for you.
Thanks, Brett. Yeah. And, as you mentioned, the agencies are looking for at least, 1, if not 2 years of tax returns. And if you are looking at the latest tax returns, the last year's tax returns, well, that's 2020. 75% of 2020 folks were dealing with the impacts of COVID. And a lot of 2020, things were shut down. Small businesses, especially, were shut down for longer than a lot of the big box stores. And because of that, when we're looking at these tax returns, the taxable income for these individuals to qualify is not there. And then pair that with the overlays that Fannie and Freddie have, you're just making it much more difficult for these individuals to qualify. Now, what does that mean? Taxable income has gone away, and it's going to take some time for it to return. But cash flow is starting to come back. Cash flow meaning businesses are starting to make the money. They may not be able to report it because of the losses that they've taken. So the tax returns may not show it, but the cash flow is there. Although these businesses were shocked, we don't necessarily need to look at the last 2 years of tax returns. Now, the same way that we did with investors, what we've done is come up with solutions for this segment of the market. People are struggling to buy houses when they want to. The market is great, the interest rates are great, and they want to take advantage of it, but it's just a matter of qualifying. So what do they do? Now we've come up with a solution where we don't need to take a look at their tax returns. No income, no tax returns, no 1099s, no K1s, none of that. We are just looking at their cash flow, their bank statements. We even have an option for them to provide an accountant statement, meaning a P&L for the last 12 months. And the accountant is telling us how much income we can use, and we will go by that instead of what the tax returns or other tax documents are showing.
And Nitish, it doesn't have to be an audited financial.
It does not. Great point, Brett. It's not an audited financial. And even the banks that are allowing this program, they require the accountant. And I don't want to go into too much detail, but the accountant literally states that this is for mortgage purposes only. So it's not a document that gets reported to the IRS. It's not audited by the accountant. It's just something that's specifically for mortgage purposes that they put together. And whatever the bottom line is that they give us, that's the income that we use for that individual to qualify.
Now, what kind of small business owners, what kind of entrepreneurs is this applicable to? I mean, are we talking everything from Uber drivers to restaurant owners?
Yeah, great question, Cindy. And yes, it's applicable to anybody, because in the mortgage industry, if you're getting a 1099, you're considered self-employed.
Mm-hmm.
Now, you may not own your own business, but another business may give you a 1099. Now, that gives you the freedom to write off your expenses and, report your own taxable income, or an accountant may be doing that for you. But those individuals are all considered self-employed, and they can all qualify. So someone who's driving an Uber, they can qualify for this program as well.
Actually, Nitish, I can't use the builder account, but we are a big lender, a fallout lender for national builders, where we're able to put together transactions that their mortgage company can't. We actually used this similar program to actually do a loan for somebody in the gig economy. She actually worked for Uber and Lyft together. She was doing both, and we were able to find a solution for her.
Yeah, closing tomorrow.
Yep, closing tomorrow. So, yep, use this program to do it. And I can't tell the builder who it was, but they couldn't figure it out, and we were able to find the solution for them. Partly, Cindy, because we try to identify where the trends are and how we have to go through this part of it. So, Tish going to share something with you that, one of the things that clients do is they wait, right? Tish, you kind of
right. And, and a lot of these individuals, they've spoken to other individuals in the industry, and they've been told that they may not qualify, or there are different requirements to qualify. And these overlays that Fannie and Freddie have come up with, they're requiring additional documentation if you're self-employed. If you own a small business, you have to provide extra months of bank statements, or additional reserves, or additional credit requirements. So they're under the impression that they may not even have an option. So they're thinking they have to wait. One of the other issues is they think interest rate is the biggest, deciding factor when you want to purchase a home. So if the interest rates are a little bit higher than conventional programs, they're choosing to wait rather than move forward. And, Brett will go into this a little bit further as to why interest rate should not be the driving force and why it shouldn't matter. Interest rates are the employment cost of money. What is your money doing for you? Now, if you are not purchasing, it's likely that you're renting. So your money is not doing anything for you. You're making your landlord richer, right? That's what your money is doing for you. And the other thing is time is a huge factor, as important as interest rates. What are you doing with your money and what are you doing with your time? Are you taking advantage of the current market? Because if you wait, that money train has left and you're not going to be able to get on and you're not going to be able to take advantage of everything that's going on in the current market. The longer you wait, the more money you're going to lose. And Brett is going to explain why.
What's interesting, right? And I do a lot of work with financial advisors. Two things, right? Interest rates are the employment cost of money. Now, Cindy, maybe we'll do a discussion one time on inflation and the impact of it, especially now, right? The reality is inflation is there. So when you borrow today using inflation, right? Just basic economics, I should borrow as much money as I can right now because it doesn't matter about the interest rates because if inflation keeps going up, I'm going to be paying it off with future dollars, right? That's why everybody in Wall Street honestly likes inflation because it benefits them if they borrowed or they're highly leveraged. The other part is when you're looking at it from a financial perspective, as Natisha shared, time is always a factor. Here's the best example. We had a lot of people when interest rates were in the fives in 2015 and they wanted the rates to get lower. Fast forward to now, rates are lower, but think about the time impact and the value of the properties they wanted to buy. So what they saved in interest rate, they lost in appreciation, accumulated appreciation on the properties. Time is a driver in financial planning and financial solutions, and we forget about that. Like Natish said, the longer you wait, the more money you lose. So, Natish, want to talk about some of the challenges some folks have?
Yeah, rates don't matter. Like we said, it's not about what the interest rate is currently, because one of the things that we keep discussing, of course, the market is changing, right? Rates have started to go up, and it's going to continue. And you may be looking for an interest rate now that if you choose to wait, you're not going to get that anyway in a year or 2 years, right?
Or 3.
So yeah, and it's just something that as you wait, you're continuing to lose. You're losing money, you're losing the appreciation on that property, and rates and value, they're inversely correlated. Where rates go up, property value goes down, and rates go down, property value goes up. So if you're waiting for, the example that Brett gave, if you're waiting for interest rates to drop, then you're going to end up paying that somewhere else regardless. Yeah. And unfortunately, the self-employed borrower, they have limited options for short term. They can file their taxes, they can wait for taxable income to go up, but what are you losing within that period? Are you losing money? Are you losing a home that you could get appreciation over the next few years? What is the loss that you're facing as you wait? So let us help you find a mortgage solution that may have slightly higher interest rates, and we'll tell you how that is not a negative impact on your finances.
Right. To Natish's point, the current rate for this program is 4%. And a lot of people go, well, 4%, I don't want to pay that for a loan, right? I want to wait until I can qualify for a more conventional loan. Well, the problem, Cindy, is at a minimum, the ability to show the taxable income sufficient to qualify will take 1 year, maybe 2 years. Okay, so I'm going to wait till I can file my tax returns because I don't want to pay 4%. I'm going to get a better rate. Unfortunately, and this is going to change, but as of last week, and this is before the Fed announcement, the Mortgage Bankers Association forecast interest rates to be at 4% in the fourth quarter of 22 and 4.3% in the fourth quarter of 23. So if you wait, right, you're going to pay the same rate anyway, right? So it's not going to get better. Now, that's going to change, right? Because I'm going to do a little blurb. My blog will be about the Fed and tapering, right? The Fed announced they're going to accelerate their tapering, which means they're taking more liquidity out of the marketplace and interest rates are going to rise faster than what we forecasted. So I'm going to wait and I'm going to be in the same place, right? Now, the problem is what happens when I'm waiting, right? Property values are going to continue to decrease. Historically, appreciation rates are a 0.5% above the rate of inflation. Now, The rate of inflation right now, historically, is about 3%. That's not now, right? We're not in a hyperinflation, but we are certainly are in accelerated inflation. You've seen that over property values over the last 2 years, which means the property values are going to grow faster than my illustration here. But a $650,000 purchase in the Naples area, appreciation rate of 3%, the value in 3 years while I'm waiting to get my income tax income where I can qualify for a loan is $710,000. So I lost $60,000 waiting for a better rate. I am never going to recoup that money. It's not just an interest rate discussion, right? Too many loan officers don't understand how to articulate the borrower. There is a cost of waiting. There's a concept economically called opportunity cost, right? So where is my money going and what is the opportunity I wasted? To Letitia's point, if I'm renting, return on rent is always zero. I'm making money from my landlord. If I want to move up, right? I think it's a time for me to leverage the gain I have on my house now because I got a gain and move into a higher property. That's fine. It's a perfect time to do it. Even though the interest rates might be a little higher, you're going to gain more on the appreciation side. If inflation gets worse, it behooves you actually to borrow more, even at a little higher interest rate. So when we look at what we're dealing with now, which is some of the special challenges, and Cindy, they're not going away anytime soon. I wish I could tell you that. I really believe that the financial guidance I heard this morning when I was listening to it, that if it was 2 years of shutdown, right, it's going to be 2 to 3 years for our self-employed partners to get out of this, right? So we need to find solutions to help them do that, right? And part of it is understanding that cash flow is coming back faster than taxable income. So instead of leveraging only taxable income for qualification, our program will allow us to leverage cash flow, which is coming back faster than income, and we can allow our buyers to buy today. Now, maybe, right, inflation wanes. Maybe the interest rate forecast will change and rates will come down. We'll get to refinance them, right, when their income gets to be where they are. The problem is if they don't buy now and they wait, property values are going to be higher and rates are going to be higher, right? That is a no-win proposition. So they were getting their tail kicked over the last 2 years from COVID. The last thing we want to do is force them to wait where they're going to get more harm because of the impact, right? The unintended consequences of policy decisions that are going to impact them in the future. We could derail them financially for 5 or 6 years if we don't provide different solutions for them. And we're going to be dealing with that for the next couple of years. And we want to be the resource to help them.
That sounds fantastic. Now, something is just kind of occurring to me after our conversation last time about investment properties. Is this strictly for owner-occupied housing, or could this be leveraged even for an income?
It can be, but the reality is, Cindy, what the better product for the investor is to do the cash flow only on the rental part, right? There are two different products. We leverage both of them. That's a great question, right? Because even investors, and we can do this with investors because we do a lot of work with investors, right? And depending on what state you're in, right? This is why Fannie and Freddie really pull back their investor products, right? In the state of Maryland, for example, if you were a landlord and your tenant didn't want to pay you, you couldn't evict them, right? So we have landlords that didn't receive their rent for 6, 8, 9, 10 months a year, right? So how do we show that if they have cash flow? So yes, we might be able to toggle between the two products to make that work. But, once again, this is like law of unintended consequences, right? Maryland, for example, thinks it's great that, the renters, they don't need to get kicked out of their house, so they don't have to make their rent. Well, what about the person that owns the property, right? They've got to make the mortgage payment. They got to make the tax payments, right? They've got to make sure that's in place. So we forgot about the negative impact for them, right? Mm-hmm. So it was kind of this, everybody was forced to make decisions because we've never experienced it before, right? No one's ever in our lifetime, and I don't think anybody alive today was alive during this Spanish flu pandemic, right? So we're all trying to guess as we go. So as the government reacted quickly, the repercussions and the unintended consequences of those policies are being felt now. Right. So that's why we have to help with solutions. So that's a great question. We can toggle between the two, depending on where they are, to get the investor loans done.
And like you said, the bottom line is the longer the wait, the more money you lose. Right. So,
Cindy, that's a basic, like I said, I work with financial planners all over the country. The reality is, right, the best advice you can give a client, starting on their financial future, is starting investing early, even if it's a little bit of money, right? The same thing from a real estate standpoint. If you want to build somebody's financial future, the first thing they need to do is buy a home, right? So the rent they're paying is going to their own benefit, not the landlord. So that adage always lasts, right? The longer you wait, the more money you lose. The longer I rent, the more money I lose. The longer I wait to buy, I'm going to lose out on the appreciation and some of the tax benefits and the other thing happen to it. And especially now, if we're on a upward interest rate trend, which we are, and if you look at the Fed's forecast, we're going to be that way probably through 23 and 24, right? You're not going to get a better interest rate anyway, right? There's trending away from us faster than we would like, unless a drastic change happens in our recovery of COVID. That's the trajectory we're on.
Mm-hmm. Definitely. Wow, solid information. Good for our agents to help get their clients in and talk to you about a customized solution, and always good information. Thank you so much, gentlemen, for being here.
Thank you. We really enjoy it.
Yeah, I want to throw a couple reminders out just in case our people are watching us this week. We are going to take a couple of weeks off for the holidays. So we look forward to seeing you again for the first week of January. Just follow our Facebook page and look for the live streams to appear there. And I also want to throw a reminder out that on January 10th, we're going to be doing an interview with Pat Patoki. We love Pat, and that'll be Monday, January 10th at 4:30. So look forward to catching up with everyone there. And until then, we were wishing everyone a happy holiday season. And as always, give us a call if you have any questions. Brett, you want to call out the phone number?
Tish, actually, why don't you give the phone number?
Sure.
I'll mistakenly give mine, and everybody needs to call to Tish.
Well, I think it's on the outro.
Absolutely.
Because I gotta pull up the specific one for.
All right, gentlemen. Thank you. We'll see you later.
Minnie, thank you. Happy holidays, everybody.
Thank you for joining us for FDM Brews. Our team is here to answer your questions. Just call 239-359-6590 or email us at dfry@fdmhome.com.